Welcome to episode 21 of the Skadi podcast. This episode is the second of a series of episodes on the topic the Greek crisis, an Odyssey and its legacy. In this retrospective, we uncover the gripping tale of Greece's bailout programs. Get ready to explore the behind-the-scenes negotiations, the impacts on everyday lives, and the lasting lessons from a nation's struggle for financial salvation. Stay tuned for an in-depth exploration of Greece's bailout epic. Join us as we discuss the origins and impacts of this financial crisis that has captured the world's attention. We hope you enjoy! On our previous episode, we uncovered the reasons behind the Greek crisis. We went back in time to find out how the economic mismanagement and excessive spending/lending led Greece from financial euphoria to dysphoria. Greece's debt crisis revealed a major weakness in the Eurozone structure: the lack of a mechanism capable of managing fiscal crises in member countries. While the crisis was ongoing, Greek bond rates were rising to attract investors that they were avoiding to invest, even in moderate uncertainties. The high interest rates were worsening the country's deficit. By 2010, it was estimated that almost 70% of Greek government bonds were held by foreign banks. The main concern for the banks holding Greek debt is that it would be downgraded by the credit rating agencies. This means the bonds that the banks were holding could no longer be used as collateral at the European Central Bank. The EU initially avoided sending a message of support to Greece, invoking the non-proliferation clause is the Article 125 of the Maastricht Treaty. But when the crisis deepened, there was a fear of a domino effect that would also impact other vulnerable countries of the Eurozone. Euro was in danger.
I do remember this time well, because the whole European debt crisis started in 2009 with the disclosure from Greece that the budget deficits were much bigger than the people thought. So, well, I was trading European equities at the time, and there were quite extreme price swings in the market where everybody was trying to figure out who had exposure to Greek debt, and not just through Greece. What other European countries would also be in trouble.
As a response to the European sovereign debt crisis, the European Central Bank wanted to increase liquidity in government bonds and launch the Securities Market Programme, SMP. This program allowed the European Central Bank to purchase government bonds of struggling European countries on the secondary market in order to boost market confidence and prevent further sovereign debt contagion in the Eurozone. The European Central Bank proceeds spending 40 billion euros buying Greek debt. In addition, European leaders also agreed on a rescue package worth 750 billion euros to support struggling European economies. This program was set by the European Central Bank, the European Union, and the IMF, and it was a temporary crisis solution for weak Eurozone economies, Martin.
That is a really interesting bit, because I think, as you mentioned, initially the EU was citing Article 125 as a reason for not helping, and then they launched this temporary crisis solution, as you said, the European Financial Stability Facility, which turned into the ESM, the European Stability Mechanism, essentially going against what they'd said earlier on, that they were unable to help because of Article 125.
Exactly.
And I do remember a few years on, the European Court of Justice backed the ESM as a rescue package, but I think at that point there was no real alternative, because we were really still in the heart of the whole European debt crisis, and for them to sort of revoke that and say no, what you're doing is illegal against the EU treaty, then would have been unthinkable.
It would be unthinkable.
Exactly.
Prior to asking for any European Union help, in February 2010, the Greek government implemented a series of austerity measures in response to its severe debt crisis. These measures were aiming to reduce government spending, increase tax revenues, and implement structural reforms to address the country's budget deficit. In April, the Greek government introduced more austerity measures, but quickly realized they failed to improve the country's economy. It was then when the Greek Prime Minister reached for help from the European Union, European Central Bank, and the IMF to rescue the country. They agreed to participate in a 3-year bailout program.
So that's interesting. So the Greek government were introducing their own measures to try and address the debt before they reached out to the EU for help. But I think I wasn't aware of that at the time.
Yeah, exactly. They tried, in the country, to help the situation, but it didn't go well. Greece's first bailout occurred in May 2010. And it was a financial rescue package in response to the country's escalating debt crisis, amounting 110 billion euros provided jointly by the IMF, the European Union, and the European Central Bank. From the total 110 billion euros, 80 billion was provided by the European Union and the European Central Bank, and 30 billion from the IMF. Germany's share of the 80 billion was Eurozone highest, around 22 billion euros.
Okay.
One of the IMF's main rules is that it wouldn't normally participate in a bailout where a country's debt is not sustainable, as it was in Greece's cases. This is because lending to a country with unsustainable debt would exacerbate its financial difficulties, making the situation worse. The financial assistance to Greece was done in order to mitigate the high risk of crisis spending to other countries, forcing the IMF to bend its own rules. The first bailout for Greece included a detailed set of conditions aimed at addressing the country's fiscal crisis and restoring economic stability. Fiscal consolidation measures were required where Greece committed to implement stricter austerity measures to reduce the budget deficit. This included cutting public spending in various areas, including social programs, reduction on public sector salaries and social benefits, and of course, tax increases to boost government revenues. Yeah, tax increases. Conditions set with the first bailout set a target of saving 38 billion euros by 2012 through further austerity measures. Greece had to change the pension system by raising the pension age and reducing the pension pot. Reforms were also implemented in the job market to increase flexibility and competitiveness, making it easier for businesses to hire and fire employees. The bailout program mandated the recapitalization of Greek banks to stabilize the financial sector. Measures were taken to address issues of non-performing loans, known as red loans, and improve the overall the banking system.
Okay.
Greece was required to privatize state-owned assets and industries to encourage investment and generate revenues. This involves selling off shares in various state-owned companies, including energy companies, transportation assets, and real estate. To guarantee that the country respected and followed the agreed reforms, the European Union, the European Central Bank, and the IMF, jointly referred as the Troika, assessed the country's finances regularly. Troika's involvement was a subject of criticism, as the austerity measures they required had significant social and economic consequences for the Greek citizens. Many argued that the strict austerity measures contributed to a prolonged recession and increased unemployment, while others believed that they were necessary to stabilize Greece's economy and financial situation.
Mm-hmm.
The implementation of these measures sparked widespread of protest, riots, and social unrest. Hard times. During the first bailout in 2010, Troika predicted that the country's debt-to-GDP ratio would be reduced through a combination of financial assistance and structural reforms to a sustainable level. At the beginning of the bailout, the goal was to reduce Greece's debt-to-GDP ratio around 120% by 2020, the threshold set by the IMF to consider the debt sustainable. Those predictions were based on an artificially low level of 115% debt to GDP that Greece was reporting at that time.
I see.
With the fiscal consolidation measures that would be implemented, the forecast was the debt would rise to 150 to GDP by 2013 because of the recession, but from 2014 the debt would start to decrease until 2020 to reach the 120% to GDP. However, the actual debt in 2013 was 178% to GDP and 181% to GDP in 2020. With the full implementation of Eurostat statistical rules in November 2010, it was revealed that the deficit to be financed was larger than previously estimated, prompting further credit downgrades. The bailout funds were designed to address the economic challenges in Greece, but the reality is only a small portion of the funds went to Greece to assist the economy, and a substantial portion indirectly benefited the foreign banks and institutions holding Greek debt.
That's very interesting again, because I think there was a lot of criticism at the time about where the funds were going, and there was a former head of the Bundesbank, Mr. Poll, said in an interview, I think back in 2010, that the first bailout was essentially largely concerned with protecting French and German banks who were exposed to Greek debt. And I think I think he said on the day that the first rescue package was announced, shares in French banks rose by 24% on that day. So you can see how much the markets were worried about the bank's exposure, and what a relief it was when that huge financial rescue package was finally announced.
It was announced to save the European banks, not Greece,
yes,
apparently. The global financial crisis in late 2000 brought the world's economy to its knees. Markets, governments, and financial institutions got deeply affected. Listen to the Skadi team of experts discussing this unprecedented event and the impacts that followed.
So this episode, what a roller coaster the first episode was, and we're left on a bit of a cliffhanger. This time we're going to kind of go from 2010, I think, right through to 2018. And 2010, we were all pre-Skadi, still in the market in different, the market in inverted commas, or certainly in frontline roles within the financial industry. So what were you doing at that time, Martin?
Yeah, well, I was trading portfolios of stocks across Asia, emerging European countries, developed European countries, and in Latin America as well. So, lots of active trading going on at that time. And I think for me, the Greek debt crisis started off the whole European-wide debt crisis, which was an interesting time. Stocks were very volatile. I specifically remember everybody closely watching developments within Europe to find out, what would be the government's approach and the ECB's approach, IMF's approach to the unfolding situation, in Greece and beyond.
So what does that do? When you're trading a portfolio of stocks, doing the job you used to do, how does that markets being volatile? How does that make it more difficult, or what do you have to do in your role? Because these are what are your customers? They're what, passive accounts?
They're generally more passive accounts, and they'll be trying to allocate any money that they are attracted into their funds in the most efficient way, looking at the holdings that they have, rebalancing where they want to be. And of course, it's much easier to sort of plan your investments in fairly stable markets. If stocks are flying around by 5-10% on a daily basis, it makes it very difficult for the manager to sort of plan the night before, get his weightings right, get the orders all finalised and checked for order lots, etc. Say, this is what we want to buy and or sell, and this is how we want to do it. Not really knowing what's going to happen the next day as the markets open. So I think it added a lot of uncertainty to the investments that were being made, and with some of the events that were happening in Greece and across Europe, the movements on a particular day could be quite frightening.
It's an interesting perspective. And what about you, DT? What were you up to?
So I was head of trading at an agency broker, and the bulk of our clients were hedge funds. And the bulk of the business we were doing, I suppose, was M&A, merger and arbitrage type business. So if I'm brutally honest, obviously I remember all the headlines, but it didn't really touch the sort of business we were doing per se. I mean, as a rule, we weren't really doing much Greek business, I can remember at the time. So, our prime broker may well have, the broker that we used may well have put up rates to be trading in Greece, but I can't really recall, and I would be remiss to say they definitely did, because it's something that really didn't impact what I was up to.
I guess that follows a question really, and I think you've answered it already, but at times like this, you do get sort of edicts from market risk management, credit risk management, limiting activity, don't they? Because you kind of go on watch.
Absolutely.
I remember that in my career.
Yeah, so we were something called we had a Model B clearing arrangement with someone called Pershing, and that means that we could act as a broker, but we couldn't commit any of our own capital. We would have to have a certain amount of capital that sat with them to allow us to do business, and that's mostly just to make sure that when there's a mismatch of things trading and then settling 2 or 3 days later, that there's cash in the account to sort of help facilitate that. So I would assume that they would, for their clients, Pershing this is, have jacked up rates or jacked up deposits that were needed to be able to trade Greek equities. And Greek equities generally as a whole, certainly back then, I remember were trickier to trade, especially trade short, because if you got caught short on those, the buying rules in Greece were very strict. Now, I'm not sure, I can't opine if this was post the crisis or this has just always been the way. Dave, you may have a better feeling on that, but we'd always have to be very clear in Greece about if a stock was held locally or in Euroclear, because there's a difference on how those would settle. And to move from one to the other, I remember always being a real pain for our ops, as I'm sure Dave can probably testify to.
Well, it's a great point to bring Dave in, really. What were you up to, Dave?
So on my side, in 2010, I'd just been hired at Santander to set us up as a primary dealer in government bonds. Now, although it was a Spanish bank, this was in the UK name. This was the old Abbey National Treasury Services from when Santander UK bought the bank. So we were putting in everything from reconciliations, controls, electronic trading, TradeWeb, Bloomberg, CTM, electronic trade matching, and of course for the first time the concept of onboarding thousands and thousands of all these sub-funds for the buy side that we'd have to start facing.
Wow, so that's a pretty interesting time in an interesting institution to be setting yourself up. Funnily enough, the Abbey National, to sort of take it all back full circle, had a JV with Bearings when Martin and I were at Bearings way back. That business has passed around the street in a number of different guises before it ended up in Santander, interestingly enough.
Where were you, Nick?
So I was in a kind of interesting transition where post 2008 I left my big trading job at Deutsche Bank in Asia, returned to the UK, markets imploded with Lehman going bust, and I found myself out of work for, I think, the second time in my financial career. Very, very tricky and difficult, but I then made the move into dealer broking with GFI, which I started in 2009 and carried on through till the beginning of 2011, when I was offered my last hurrah in trading at Cantor Fitzgerald, but I never considered that a trading job, because it wasn't a trading job, because actually the capital that was discussed, let's say, I would say promised, but discussed before I got there, they weren't able to produce that capital actually once I'd arrived. So then it became a broking job, and then that finalised my decision to come away and start Skadi. But I think what was interesting in doing that job, and this was sort of part of why I wanted to have this discussion, is we've all been involved through our careers in times where you've had crises. And when you're in a crisis, obviously, servicing customers is difficult, trading is difficult, operations is difficult, there's stresses and strains. But also, afterwards, you never really know, or you never feel like you're out of a crisis. It takes a while for you to kind of realise that things are okay. And there's sort of follow-on jitters that happen. So what I think is so interesting about the Greek crisis, the length of it. I mean, it's such a great story that Alexandra has put together. Yeah, going through all of these years. I mean, it to me, the period we're talking about now is the Greek crisis, but actually what she's opened my eyes to is how far back this goes, and it's a really fascinating story, and that's why it's exciting. We've got this into 3 episodes. Oh my God, what's going to come in the next episode? I'm really excited about what we're going to talk about in this episode, because there's so much. But it's that sort of situation where, I went from a sort of, massive trading position at Deutsche Bank in Asia with huge liquidity. The liquidity buffers were off, and truthfully, I was getting, under so much pressure from my boss at Deutsche Bank to up the size of what we were doing. And I was explaining to him at the time that we didn't have the liquidity. I had to operate within the liquidity. It was dangerous to go any bigger, but it was all about being the biggest in the market. To then a broking role when traders, come 2009, had no capital, and they were leaning on the broker for prices, because that was the only way you could access capital, was by using other people's capital. So it was a really interesting time to be an interdealer broker, to find yourself in that kind of demand. And then into 2011, which was a terrible year for bonds because of all of this activity. There was so much uncertainty around. And opening a trading desk at that time, focusing on convertible bonds, but convertible bonds are such a bond-like product. People often think about the equity side of it and the conversion option, but convertible bonds really are interesting assets to trade in all of the zones. But when they're down in that bond zone, it's really difficult, with the credit concerns and are people going to pay puts and so on and so forth. So it's a really interesting time to be active, and this was a really particularly difficult period to be trading at the time. So I thought it was a really interesting way to open this episode, to kind of set that tone, because we kind of, all of us had kind of gone from this sort of, that global financial crisis was such a watershed, wasn't it? Because time before that, the rules were different. You had big capital wherever you were, by any measure, compared to the capital that you had afterwards. And also the other thing I think that changed was the attitude towards customers. Because customers, again, there was so much more consideration and protection of customers afterwards, and rightly so, because of the terrible behaviour that occurred, pre the crisis.
Yeah.
And we know that firsthand, because, my God, Skadi, for the first 4 years of its life, spent, helping banks go back and go through all of the kind of the toxic behaviour and put right culture and conduct, and examine things like, benchmark setting processes and all of that kind of stuff. All of our focus of our first 4 years was really unravelling and trying to strengthen and protect banks against, the conduct that had gone on before.
The first bailout faced significant challenges in implementation and effectiveness, leading to the need of a second bailout for Greece. The second package was designed to provide Greece with additional support, address the deficiencies of the first bailout, and create a more sustainable path towards the economic recovery and stability.
Yeah, probably some of the deficiencies of the first bailout were that not all the funds ended up in Greece that were segregated and are supposed to go to them, because a lot went to save the banks.
They went to save the banks. By the end of 2010, the European leaders realized that the rescue program they designed for Greece, collectively with the IMF, wouldn't make it to the 3-year length they initially predicted. Their main concern was not for the European central banking system, as we said before, as they were already settled.
Yeah.
They realized that the Greece's crisis started to affect other European economies, mainly the Southern European economies.
Okay.
A new concern that a Greek default would shake the international markets prevailed. And here comes the question, Martin. If the EU failed to rescue a small country like Greece, what would happen where more and larger European economies would be in the same position?
Yeah, that's a big question they had to deal with.
Exactly, I think it shook them. In October 2010, the Davos summit came to change how the European Union handled crisis. The German Chancellor, the French President, agreed to the principle of PSI mandating losses for sovereign bond investors. PSI was paving the way of a cut of the Greek debt. Before the PSI, Troika held a significant amount of Greek debt. The exact percentage varied, but the share was not included in the debt reduction because it's not possible to reduce a debt that has already passed through the official institution's hands. The strange thing here is that it was obvious from the beginning of the crisis that the Greek debt needs to be cut. But Troika first accepted the debt in 2010 in order to cut it later instead of doing the other way around. However, the decisions were both political and bureaucratic.
Mm-hmm.
What was precisely predicted by the PSI was that the public debt owed to private individuals was in form of bonds. By the end of 2011, the Greek debt exceeded 350 billion euros, where 205 billion euros worth of debt bonds were held by private sector through GGBs, Greek government bonds.
Okay.
With implementation of a PSI, the country invited all these private bondholders to tender the bonds and receive 15% of their nominal value in short-term notes guaranteed by the Troika and a 31.5% in new Greek bonds. In simple words, Martin, private bondholders were asked to trade in their Greek bonds for new ones, offering lower interest rates and longer maturities. This Greek government bonds exchange resulted in a haircut of 53.5% of private sector.
Wow, this is the private sector involvement, the debt restructuring program, and obviously the sweetener was the 15%, in short-term notes guaranteed, but then the ECB had spent 40 billion on Greek bonds, and they managed to exclude themselves from the PSI or debt restructuring program together with other Central European banks, and I think. This upset an awful lot of people, I remember at the time, and I know in the end the European General Court sided with the ECB as being able to do this, but I think at the time it created a lot of upset in the market and disbelief at how they could be treated differently to the other bondholders.
It's sad, though, to consider that the European Central Bank didn't participate, but the Greek banks they did, and they saw their bonds being cut almost 0.5%, so they lost. Amid public anger and austerity, the then Greek Prime Minister calls for a referendum on a second bailout agreement. Shortly after, he called off the referendum as the rest parties of the government agreed with the renewed bailout program, and as a result he resigned. Greece, under a new government, signed for the second bailout program and implemented further austerity measures and structural reforms. The Greek government announced the terms of the bond exchange on February 2012 and invited bondholders to tender their bonds the following month. If a large percentage of private individuals consent to cutting the debt, it would become compulsory for the rest. The government imposed a collective action clause which forced any reluctant investor to accept the exchange. Among the bondholders who saw their bonds cut were the Greek banks, which had deposited a large part of the public's deposit in these bonds.
Yeah, I remember that collective action clause was inserted into the agreements of the domestic bondholders afterwards, and I know that there were foreign bondholders, or some foreign bondholders still there, obviously not as many as there would have been at the start, but a lot of those got restructured as well, but there were holdouts, there were a number of bondholders that held out, totaling I think about 6.4 billion euros, and eventually the Greek government actually did settle and pay them out in full so that they didn't have to have a haircut either. So I think the remaining foreign bondholders that didn't go for the restructuring plan in the end got their money back, but I think it was a bit of a long drawn out process.
Overall, the PSI cut 106 billion euros. It also generated losses for the Greek banks that would need to be recapitalized. Those losses were necessary to be returned to the banks to prevent them from collapsing.
Okay.
The recapitalization cost the Greek government approximately 38 billion euros, of which 18 billion was estimated to be due to the losses from the PSI, and the rest to other operational losses of the banks, mainly due to bad loans, the red loans as we said before, and the general crisis.
Okay.
In those times, the Greek economy had little liquidity, and it was obvious from then that the Greek banks would live in poverty in the coming years and a new recapitalization would be necessary, as it happened. After the PSI bond exchange, Greece received the second bailout package amounted 130 billion euros, larger this time. So this time through the EFSF rather than directly from the European Union members, reducing the risk of a Greek collapse and the Eurozone as a whole. The success of the PSI in Greece was a matter of debate. European Union considered successful because it helped Greece to manage its mandated debt crisis and avoid the default. However, the broader economic and social impact of the austerity measures in combination with the ongoing challenges in countries' financial recovery have led to ongoing discussion regarding the overall success of the program.
Interesting.
So what's amazing, always what I love with this career is when you've been through something, you move forward 10 years and then you look back and you almost can't believe, you have to sort of pinch yourself at what went on. The PSI is quite an incredible bailout, and it really underlines one of those things that happens, and this sort of feeds so much through to the kind of expert witness work that we end up doing, because it's just such fertile ground for disputes. Any situation where you get one class of investors or holders treated by a different class just leads to so many problems. Immediately you end up with those disputes, but it's the precedents as well. It's what it does going forward. And I often sort of say, the markets have short memories, but the markets actually have very deep memories for certain things. And I can think of a similar situation, thinking about how the ECB treated itself versus other bondholders in Greek paper. You had a kind of similar situation with India, with the FCCB market during the aftermath of the global financial crisis, where there was a court ruling that treated Indian domestic banks better, effectively made them senior in terms of the money that was owed to them by issuers versus the holders of FCCB paper. So it effectively juniorized FCCBs, which was great. India protected its financial institutions, but it did mean, and because I was trying to sell Indian convertible bonds in 2011 through a JV with GFI and ICICI Securities, that hedge funds just wouldn't buy Indian FCCBs, or certainly they would never consider them under the same sort of terms that they would have done 4 years earlier. So it can be very, very damaging to a market going forward when you have these kind of decisions, because rightly so, investors think, my God, the risks inherent in this stuff is so much more present than we realised. And I think you made the point, Martin, that then people kind of are looking around the rest of Europe that this could happen in other places, right?
Yeah, I think obviously the size of this just unprecedented in what they did. The ECB had 40 billion euros worth of bonds themselves. You had, as you said, the domestic investors. You've got the foreign investors, and people from the market side. If you look it in, and watching what's happening to the foreign bondholders, basically being forced to accept a haircut. The domestic bondholders being forced to take a haircut, and some foreign bondholders restructuring, some foreign bondholders holding out. The confidence drains from the whole bond market, and everyone's looking at other countries in similar distress and thinking, why would you hold? If you're a domestic bondholder, why would you invest? It's because you just don't know if the terms that you think you've got are going to be overturned.
And that's always an interesting point as well, DT. We've had it over the years where someone turns up with a piece of paper that's slightly off the wall because they've been a kind of holdout investor.
Yeah.
They haven't accepted the terms on something, and then they want a price on something that's a little bit different, not as liquid, probably not fungible. I mean, we've had situations like that, haven't we?
We have, yeah. I'm scratching my head. Chuck me under a bus, why
well, I certainly can remember a circumstance with Cubana Airlines that turned up with a line of paper at a time when obviously Cuba sanctions way back then,
yeah,
where you couldn't deal with them, and they were looking for a market in this piece of paper. So it wasn't necessarily that I think that was Quant was the stock, I think. where the paper wasn't necessarily different, but it was just the fact that you couldn't deal with the holder on that one. Anyway.
The transition from the second bailout to the third bailout for Greece was marked by a series of negotiations, challenges, and decisions aimed at addressing the country's ongoing financial crisis. After years of austerity measures and social unrest, Greek citizens grew wary of the harsh economic condition imposed by the bailout conditions. On January 2015, general elections were held and Syriza, led by Alexis Tsipras, emerged victorious. Syriza's election was significant because it opposed many of the austerity measures. End of June, the second financial assistance program from Greece, which was financed by the European Financial Stability Fund, the EFSF, as we mentioned earlier, it ends.
Okay.
The Greek government missed the 1.6 billion euro payment to the IMF, making it the first country ever to effectively default to the organization.
Wow.
The new Greek government sought to renegotiate the terms of the bailout with Troika. The negotiations between the two proved challenging, with Greece requesting debt relief and relaxation of austerity measures. The standoff raised concerns about a potential Greek exit from the Eurozone, the so-called Grexit. To stem capital fight, the Greek Prime Minister had previously announced emergency capital controls limiting bank withdrawals to €60 per day after the European Central Bank restricted its support. The banks were closed for 3 weeks between June and July to prevent a bank run by anxious customers who feared economic meltdown and Grexit. The controls put a severe brake on economic activity.
It must have been a nightmare, situation. Banks closed for weeks. People worried, couldn't get money out. It's just everybody's worst nightmare.
Imagine, everyone was rushing to the ATMs, but at some point the ATMs they're gonna run out of money, so you're gonna end up without money. How are you gonna survive?
What a terrible time!
It was horrible. I remember I wasn't in Greece. I wasn't living in Greece during that time. I left 2015 before the capital controls, but I went later on in the summer, and it was horrible. People were even for me, because I used to have my card and my and cash with me, and when I was going to take money from the ATM, it was a limited amount. It was how can I live with this small part of money?
Yeah.
And I was only on holiday. Imagine if you have to feed your family.
Yeah.
It was
just truly awful.
It was horrible. Before the negotiations, both Greece and the creditors, now they are called creditors, not anymore Troika.
Oh, okay, Troika.
Every bailout, they have a different name. Yeah. And the creditors only were considering a potential conflict between them. The European Union believed that such a conflict was a matter of time. Yes, because you're putting more austerity measures. Greece at some point,
you can only push. You can only push so much.
At some point, they're gonna explode.
Yeah.
And as I said, it was when it actually happened. The conflict between them. They freeze the financial assistance to the country, which was still on the second bailout. On 5th of July, 2015 marked the day, the Prime Minister calls for a referendum on the third bailout agreement. As a result of the referendum, the bailout conditions were rejected by a majority, with over 61% of Greek citizens voting no. Despite the initial resistance, though, the Prime Minister ultimately faced the reality that the Greece's economic situation was in a perilous position and the country's financial stability was at risk. Shortly after the referendum, he agreed to a similar set of conditions to those that had been rejected by the Greek citizens.
By 61% by the time.
And he agreed on stricter austerity measures.
Wow.
So this decision was made to prevent the potential Grexit and secure Greece's position in the Eurozone. The Minister of Finance, Varoufakis, resigns immediately after the referendum. When the government accepted the bailout agreement, he called the deal as a new Treaty of Versailles, if I'm calling it correct. This comparison was to emphasize the perceived severity of the austerity measures and economic reforms imposed to Greece on the third bailout agreement. He aimed to highlight the potential negative consequences of implementing stricter austerity rules, as he believed it could lead to long-term economic damage and social unrest. Of course, you are painting the country. The Minister of Finance believed that threatening to leave the Eurozone could provide Greece with a leverage when negotiating with its creditors, as it could have significant implication from the stability of the Eurozone itself. He considered even a new currency, listen to that, as part of his negotiations. He proposed the idea of a parallel digital currency, often referred as a digidrachma.
If that was happening now, it would probably take off. It would be over the blockchain in no time at all.
Of course. So that digidrachma could run alongside the euro. This currency could be used to facilitate transaction within Greece and potentially provide the Greek government with more control over its monetary policy. Although this crazy idea was met with great skepticism and concerns from both Greece and Europe, and it did not ultimately come to fruition. Listen to this. The German Minister of Finance, Schäuble, had a Grexit plan already if the country wasn't agreeing in the fiscal austerity measures and reforms. And he wasn't taking in consideration the threats like from the Greek finance minister of leaving Eurozone and running a parallel currency. The German minister wanted to create this strong European core, and by that he meant fixing Eurozone by either expelling the unbehaved countries, if you want me to say that, or with more reforms and conditions. His rule was adapt or leave.
Right.
So this, the 5-year Grexit plan was ready to execute, it was everything set. But the EU continued to support Greece staying in. It was then when him and Merkel, they had the conflict between them, because she wanted to help Greece, she wanted to keep Greece in Eurozone, but he said no.
And I think in the UK, obviously there are strong domestic issues and a split party with regards to a healthy dose of Euroscepticism. And I think, with all this happening in Europe and the ECB changing their rules, the EU changing their rules, with regards to Article 125, the IMF bending their rules, and the drive for ever closer financial cooperation and sharing of burden. I think it would have had effect, and many people think that it had quite a strong effect on the government's decision in the UK to bring up the idea of a referendum on leaving the EU in 2013, ultimately leading to the vote to leave in 2016. So I think this all this panic and worry and unrest throughout Europe and the sharing of debt burden would have certainly contributed, I think, to the change or the hardening stance of the UK government, with fairly far-reaching consequences as a result.
David, at the same time, there's pretty big things happening in Spain, weren't there, at this time?
Yeah, there were. So we were in London, but what happened to us, it was the first half of 2012, we had to urgently take in cash deposits in London in the name of the bank set up in the UK.
Why was this?
That was because of the downgrades that were happening to Spain as a country. They were constantly being downgraded. So we had, as a bank, clients in Spain that had deposits that we very, very quickly, overnight, had to move into London. We didn't just have to move the deposits. We had to onboard those clients. We had to set up all the infrastructure, the controls, to make sure that their Swift messages would come through to us correctly. Would the messages hit the Swift screening software? Would they pay late? Would they format the messages correctly? Would we be able to handle all of that infrastructure at the very last minute?
So it's amazing. These decisions, like rating agencies downgrading somewhere, etc. You can see that manifested in price action, but you never realise that kind of operationally the strains it can put institutions under, because there's a domino effect that goes on that you've just described, going on behind the scenes, right?
Exactly, yeah. And working in the kind of off the cuff on operations, this is a classic case of where you're the first person that's got to do it, but you can maybe be the last person to find out. So you're having to mobilise very quickly to get up to speed with this, which is of paramount importance. These huge deposit balances coming over, these clients that you've not spoken to before, they're going to pay the funds on time. Can they format their SWIFT messages correctly? Are they going to, hit an amendment queue, things like that?
Well, the reason for that is because all of this stuff takes place, and the front office are just frantically dealing with stuff, going for it, but they have no concept of what's going to go on behind the scenes, in ops.
That's right.
And that's kind of, it makes me think there's a good avenue for training there, Dave.
And communication.
Communication first, training second, probably. Yeah, that's fair.
Before the third bailout, European Union granted Greece a short-term financial assistance, a bridging loan, of 7 billion euros to cover critical debt repayments to the European Central Bank and the IMF. The repayments were required to be paid immediately, within a short amount of time. The third bailout for Greece, which was agreed on August 2015, was amounting 86 billion euros and was through the ESM. Greek banks got 10 billion euros to recapitalize them. While the IMF participated in the previous two bailout programs, on the third one refused to participate until the creditors provide Greece a significant debt relief to make the debt sustainable. The program came with a set of targets that Greece had to meet in exchange for the financial assistance.
Okay.
These targets were often a source of political and social tension within the country, leading to protest and general public unrest. The implementation of such measures was a challenging and complete process, and it remained a topic of debate and discussion throughout the third bailout. Greece, though, implemented the reforms step by step throughout the years until the end of the programs.
Right, they made it through.
During the third bailout, the credit rating agencies upgraded Greece as the country was making a significant progress implementing the reforms. The upgrades were progressive, reflecting improved confidence in Greece's ability to manage the debt. Greece returned to the financial markets in 2017, issuing the first 5-year bond, which was well received by investors.
Yep.
This move signaled a degree of confidence in the country's ability to access international markets again. Listen to the Skadi team discussing the negative rates around the period and the issues they caused.
Okay, so once we had all this deposit business happening and working nicely, it was then in June 2014 when the deposit rate at the ECB actually turned negative. So it was flat before, but they went negative 10. So obviously, as a bank, we would hold our euros with a cash correspondent, who would then place them overnight with the ECB, who would charge us interest. So then we had to start charging interest on deposits on long balances.
Wow.
So you start thinking about it. We're looking at things like, can the system, we know the system can calculate interest, but can it calculate interest to deduct the interest on a recap account?
Yeah.
And not just that, but also the accounting. Will the general ledger, send the entries the right way for the double entry, because everything's reversed.
Yeah.
Everything's different. And then if you've got a client who's going to get interest at the end of the month, we can't take that account down to zero. They've got to leave enough on the balance that we can take off of them that we're going to charge them for the interest, because it's negative.
Mm. Yeah, and I think you've raised this a few times, Martin, that negative pricing causes no end of problems, just for what Dave talked about. The modelling, no one's expecting it.
We've seen it recently, the price of oil, and the systems. Even though it's been fairly well flagged that the prices, could go negative, then people just aren't ready, and they don't test enough, and they don't build in the resilience into the systems that they need to when these, black swan events, whenever they occur. it's scary, really.
And this was a black swan, but actually it wasn't, because this became business as usual pretty soon, right? Because it wasn't like an aberration. Like the oil thing was an aberration, wasn't it? It was like a black swan.
Yeah.
Oh, they're negative, but then it's come back. Where can I get some storage for this stuff? Kind of thing. But this was now the way of it, wasn't it?
Negative rates. Rates of 0. For the next 10 years plus. It's
I mean, with the ECB deposit rate, that went further and further negative to negative 50 bips. And it was only last year, July 22, that it actually got to a flat rate. So, as we say, this isn't something that's just happened one day. This became the new normal.
Yeah, and that becomes the norm. And then as soon as they start going up rapidly over the space of a year, you got regional bank failures. And, whoa, what's this? We haven't got 0 rates anymore. It's where's all the free money gone?
And this is also where you think about things like where you're offshoring and you've got staff who are just not in the area, the geographical area, to kind of put 2 and 2 together, because it may be blatantly apparent. You got someone in Madrid thinking about this, going, oh no, I totally get that rates negative. But if you're doing this from someone in Southeast Asia or someone in Central Europe, whatever it happens to be, it may not be the case that they're aware of this. So they may just look at that ledger entry that you're talking about and go, oh, no, that can't be right. Reverse. And then you get these little errors incrementally adding up every day until someone discovers it. And that's the horror story, isn't it, Damian? When you discover small errors that have been building up over a period of time, and they can be a big error, and they never go for you, do they?
Yeah, no, they always go against you. It's like FX. Whenever you've done an FX the wrong way around, you discover it 2 weeks later, and it's never gone your way. You've always lost money.
Always against you.
So yes, all fun and games.
The European Union turned the page on its darkest period as Greece formally completed all the reforms required and is getting ready to exit the bailout, but only after the Eurozone's leaders sealed the deal of a debt relief. Key elements of the debt relief were extension of maturities, reduction of interest rates, grace periods, debt buyback at a discount, and reinvestment of profits from Greek bonds by the European banks.
Okay.
With all these measures, the creditors could safely say that the Greek debt would be sustainable. But the country was still facing challenges. For many Greeks, the years of economic hardship were severe. People were desperate, they were hopeless, were struggling, they were protesting, they were rioting as they suffered the strict austerity. It's normal.
Oh, definitely.
The economy was growing really, really slow, and the unemployment rate was high, peaking like in 2013 it was 27%, and for the young generation was at 58%.
Wow.
I was part of that 58%, to let you know.
That's an incredible number.
And shortly after, nearly 500,000 of young Greeks fled the country, including myself. People believed the bailout deals, rather than saving the country, harmed it. After 9 years of unprecedented economic hardship, Greece exited the third bailout on 20th of August 2018. So ends a series of 3 bailouts designed by Troika.
Or the creditors, as they know.
All the creditors,
yeah.
exactly, all the creditors. And then a total of 289 billion euros was lent to Greece in the wake of the financial crisis to stop defaulting on its sovereign debt. A new era started again for Greece, Martin.
Wow, what an episode, Alexandra. There's been so much going on there. It's just hard to take it all in, but thank you for sharing that with me.
You are very, very welcome. You've been listening to the Skadi podcast. This episode was the second part of a series of episodes on the topic The Greek Crisis, an Odyssey and its Legacy. Join us for part 3, where we will discuss the social and financial situation of Greece after the bailout programs. On the discussion panel today was Nick Corry, Damian Taylor, Martin Anthony and David Bridges, with research and interviews carried out by me, Alexandra Mexi. If you want to listen to more episodes, just find us by searching the Skadi podcast on any streaming platform. Feel free to connect to us at Skadi Limited on LinkedIn to read about our research and business relation to anti-financial crime and control functions. Until next time, σας ευχαριστούμε για την ακρόαση.